Well, we've got more on Bernanke's Jackson Hole speech right now. For that, we turn to Steve Blitz. He's director and senior economist at ITG Investment Research. He is with me here in the studio. Steve, good to see you.
Good to see you, too.
So is there anything that Ben Bernanke can even do at this point to address the economy?
I think, the way to look at the speech is really twofold. I think it's a political speech more than it was an economic speech, number one. And number two, with the GDP numbers and the numbers that we look at, there's also a bit of an economy or an underlying economic trends that I think you have to look at that gives them this time.
And when we have, well, speaking of GDP, of course, we had the 1% revision, the revision to 1%, I should say, for the second quarter. That does not look like a recession, at least not yet. So what buys him a little more time? Is it just that things could be worse?
Well, it could always be worse, as the old joke goes. But I think what buys him time is this. The economy did not contract in the second quarter. The economy did not contract in July. The data we're looking at shows some risk in August, that the economy may have contracted a little bit in August, and obviously the further knockoff effect in September. So he's right to wait to the end of September before doing anything, because we really don't know. We've got a lot of flows in the data from reduced and then increased auto production and imports, so that's playing a little bit of havoc with the numbers. But whether it's plus 1% or minus 1%, it's not good enough. And to me, the telling paragraph in Bernanke's speech today was about long-term unemployment and the dire consequences of continued long-term unemployment, and how this is an extraordinary time requiring extraordinary policy moves. But having said that, right, he's hamstrung right now politically. We saw the three dissenters back in in the last FOMC meeting, and the problem is they are more focused on inflation than unemployment. If you go back a couple of minutes ago, not a couple minutes ago, but a few minutes that were released, the Fed talked about how unemployment is a structural issue. As a consequence, we're closer to a full employment type of economy, and as a result, policy is going to give you more inflation than not.
So let me ask you this. I mean, President Obama is expected to speak soon to perhaps introduce some new measures on the economy. Politically or not, just in terms of what the Fed does and what the president can do, is he in a better position now than is the Fed in terms of fostering job creation? Well,
he's absolutely in a better position. And Bernanke was 100% correct in punting a bit towards the fiscal side of the field, because the problem is not one of supply. The problem is one of insufficient demand. And fiscal policy is truly much more adept at stimulating demand than monetary policy is. And so he's 100% correct. However, the Fed will do something at the end of September if he can convince, through the data we get through August and September, that the inflation hawks, if he convince the inflation hawks that inflation is coming down, because he said he expects inflation to drop below 2%. He's signaling that his view of the world over the next, say, 4 to 8 weeks is going to be in favor of getting back into the arena of policy, of doing something.
Do you agree with him? Do you think we're going to see inflation come down below, that the economy has slowed enough that it's pushed inflation down?
At 1% growth, with 9% unemployment and no true wage growth, it's impossible to get the kind of inflation that the Fed members and others are traditionally worried about.
So you think the dissenters are wrong? Do you think he'll prevail in his argument?
I think he'll prevail in his argument. Fed chairmen usually do prevail in their arguments anyway, but I think he will prevail. And the reason he's going to prevail is because we have an inflation here of a very different kind. It's an imported inflation. It's not generated by demand. It's generated from overseas prices. And as such, it looks the same in CPI, but its impact on the economy is entirely different. The impact on the economy of outside price increases is a tax on margins, and it's a tax on consumption, and we saw that in the second quarter.
So do you think that QE3 is the right thing to do?
Not necessarily, no. And I think that's where we'll have to wait and see. I think he has to do something to directly attack the banks and directly attack how getting the banks to lend, especially to middle and small-sized firms that do not have access to capital markets.
Well, and the QE that's already come has not achieved that.
No, it hasn't. What that QE was really about, and where it was successful, was depreciating the dollar back to the levels where it was before the recession took hold. And the dollar needs to get lower still. We are shifting in our economy from a finance and real estate focused economy with high leverage to a lower leverage real goods economy. And where we need growth to sell our products is in exports. That's why he specifically mentioned real production. He being Bernanke, he mentioned production. He mentioned export growth. And you're going to hear the same from President Obama as well. The idea that you can generate solely from domestic sources and uses growth rates, that's a thing of the past. It's a thing of the past, absolutely.
Steve, thank you so much for coming to talk to us about this. Obviously an important speech, but stay tuned, I guess, is the bottom line.
Always stay tuned.
Thank you so much. Steve Blitz is senior economist at ITG Investment Research.